Thank you, Veronica, and thank you all for taking a bit of time to gain further insight into this new tax legislation. During December of 2015, Congress enacted the Protecting Americans from Tax Hikes Act of 2015, commonly known as the PATH Act. This presentation will outline 3 topics of importance for both individuals and businesses related to the PATH Act. A complete discussion of this new PATH Act is beyond the scope of our presentation and obviously of your valuable time. In the first topic, Paul Cosentino will give a brief overview of the recently enacted small business extenders. Jay Wadsworth will then present the second topic, focusing on the individual extenders. Lastly, we will briefly discuss some of the tax business credits that have also been extended or that have been made permanent. Some of the tax business credits that have also been extended or that have been made permanent. Paul?
Well, thank you, Javi. Thank you, Veronica. So I'm going to start off by talking about some of the small business extenders, which most significant adjustments that were made or acts that were put in place by the IRS were to allow faster write-offs of fixed assets that are purchased by businesses. And the ability for a company to actually be able to write off the purchase of fixed assets that they will own for a very long time and over a faster period results in significant tax savings to organizations, and thus has been proven to help the economy quite significantly. So the first of which is something you may have heard of called Section 179. Section 179 is a provision in the IRS where they allow you to take the purchase of a fixed asset and write it all off in 1 year up to a certain dollar limit. Again, these laws were intended to help small business, not the larger corporations. And that limit was at $25,000 per year, which is not significant. And then Congress allowed that limit to be increased several years ago up to $500,000, assuming you purchase no more than $2 million worth of equipment in 1 year. I have first-hand experience knowing that when Congress allowed this $500,000 write-off of fixed assets, that a lot of companies would go out and make significant investments, upgrading their equipment, and buying these items for that faster tax deduction. So the limits right now is $500,000 of a write-off of fixed assets purchased up to $2 million. It will be indexed by inflation, and that has been made permanent. And prior to this, Congress would have to act each year to decide whether they were going to extend this. In many cases, they didn't make that decision until December or even after year end, which defeated the purpose in that businesses need more time to be able to write off those dollar amounts.
So the value of this, Paul, is really in the fact that for now, for 2016, an individual, a small business owner or business owner, can proactively plan in their asset acquisitions knowing full well that they're going to be able to expense up to $500,000?
Yes.
Instead of, as it's traditionally been, where we had to wait until the very last week of the year, and then we had individuals scrambling for those acquisitions and the subsequent tax write-off.
Correct, and at that point, many of the businesses may not have had the cash flow or financing available to be able to make those write-offs. I'll give you an example. If you're able to finance equipment and pay that over a number of years, this could actually be a cash flow positive thing for a company to go out and buy a $500,000 piece of equipment. If they're financing that over 5 years with a cash outlay of $100,000 per year, and they end up getting a full write-off of a $500,000, their tax obligations could go down by a few $100,000, thereby giving them cash flow up front, and the purchasing of new equipment helps the economy when scaled over many businesses. So I'll get into a little bit more details about what qualifies and what doesn't. So, for example, when you purchase fixed assets, there's something called personal property and there's something called real property. Personal property is anything that's not real estate. Real property is real estate and real estate improvements. So the items that qualify for it, for Section 179, are just the personal property. Your furniture, fixtures, equipment, and vehicles with some exceptions and limitations, so on and so forth. And then there are some real estate property that can qualify. The IRS came in and allowed certain benefits for items that they call 15-year property. These include certain leasehold building improvements for retail buildings and restaurant property. Otherwise, all other types of building improvements and building purchases have to be written off over 39 years. So it applies to personal property with the exception of those building improvements I just said, and what happens is upon purchase of those items, you can write it off all in 1 year instead of having to write it off over useful life. I'll give you a few examples of useful life. Equipment is typically written off over 5 years under the IRS rules. Furniture and fixtures over 7 years, so on and so forth. So this will allow businesses to start planning. There is another provision that will help larger organizations that is not subject to that $2 million limit. The IRS has what's called 50% bonus depreciation. So they're going to allow a business that goes over the $2 million total purchases to be able to write off 50% of whatever they purchase all in 1 year, and then the other 50% has to be depreciated thereafter. There is another reason why that Section 179 doesn't work. That Section 179 is only allowable up to the point where you have taxable income. So for example, if an entity actually is losing money or is at a break even in a particular year, and they may do that intentionally because they're investing in a growth organization and they have investors funding that, those investors aren't going to be able to take advantage of this faster write-off because Section 179 is only allowed to the point where you have taxable income. So this bonus depreciation is allowed even if you don't have taxable income. It can actually allow it to go to a loss, which most businesses or small businesses are pass-through entities. A pass-through entity is an entity that actually reports the income and expenses of the organization on a tax return, but then passes that through to the individual owners of the company on what's called the Schedule K1.
One thing, Paul, when you talked about the restaurant industry, another thing that came to the forefront was revenue procedure. In fact, there's revenue procedure 2015-56, which provides for a safe harbor for retailers and restaurants to be able to expense and provides for a safe harbor for restaurants and retailers to expense up to 75% of remodeling costs. Those can be written off as repairs, and 25% are capital expenditures. Again, the revenue procedure has the list of qualifying remodeling activities, so that's also a valuable piece of information for you to consider as a small business owner if you're in those two industries. Paul?
Thank you, Javi. Thank you for interjecting that, and also actually that segues perfectly into my next topic on fixed assets. So for most of you who may have had experiences with owning property, you probably understand that the accounting department always has a question as to whether or not an expense that's incurred on the actual building or property, the question of whether to expense that as a repair or to capitalize that as an improvement. In the process of capitalizing it as an improvement, the concern there is if you capitalize an improvement, you can't write that cost off faster. All in 1 year, you have to write it off over many years, where a repair is written off in 1 year. So the IRS came out with rules, finally gave clarification to everyone and standardization of how the determination of whether a capital improvement is depreciated over many years or expensed. And one of the things they came out with was a de minimis expense rule. Said for any purchases, whether it be personal property, computers, so forth, and building improvements, you can write them all off in 1 year up to $500. That just got increased effective 1/1/16 to $2,500.
Excellent. And also, the IRS has indicated that they will not challenge it back to 2015 if the 2,500 is used for 2015, correct?
That is correct. That is correct. So it's an opportunity for this filing year and then also in planning moving forward. Last thing that I'll mention about all these fixed asset write-offs for the small business extenders is that the IRS made permanent the ability to revoke an election or change its specifics without getting consent from the IRS. That's significant when things change and you want to take an opportunity to do something a little different this year than you may have done in the prior year. So with that said, I will pass it over to Javi. Take it from there.
Thank you so much for that valuable insight. As we move forward, Jay is going to now talk briefly about the individual extenders. Again, the quantity and the volume of the information associated with the legislation is quite large. We will try and stick to the highlights in order to keep this presentation to under 30 minutes. Jay?
Right, Javi. Well, for the individual extenders, there really isn't anything new that came out with the extender bill. We are going to be operating in 2015 pretty much with the same rules we had in the 2013 and 2014 years. However, most of these provisions expired at the end of 2014, so we were not going to have these going into this year, 2015 and beyond, so Congress corrected a couple of these items. I'm going to go over perhaps the ones that we see clients use the most. The first is an exclusion of up to $2 million of discharge principal residence indebtedness from gross income extended through 2016. What that means is typically when you have forgiveness of debt income, when you have debt that's forgiven to you, that is income to you. You must pick that up on your tax return and pay tax as a result of that. However, a few years ago, it was put into law that if you had a foreclosure upon your home and it had some debt written off as a result of that, that is not taxable income. That, however, was expiring at the end of 2014. That has been put back into place for 2015 and 2016. So if you do have a foreclosure, if you do have some debt forgiven on your primary residence, again, this has to be the home that you live in as opposed to investment property or a second home, then that income will not be included in taxable income for you in that year as long as it's less than $2 million.
Additionally, how does it work for individuals that have a Schedule E rental properties on their 1040? Is there an additional step for them to qualify, or that property doesn't qualify at all?
No, it doesn't qualify at all.
Okay. Continue.
The second, and probably the most important thing, probably one of the nicest things here that was done is for us here in the state of Florida is the second one, which is an option to take itemized deductions for state and local general sales tax instead of taking the state and local income tax. As of a few years ago, you could take on your tax return a deduction for state tax that you paid. For states like Florida and other states that don't have an income tax, we didn't get any benefit for that. So what they did was a few years ago was to allow us to deduct sales tax that we paid, and that was deductible on your tax return. However, again, that expired at the end of 2014. That is now back in place, and in fact, it's permanent. So you can kind of plan for that. The way practically this works, because you can either keep track of the actual sales tax deductions that you pay during the year, which I realize is difficult, or there's a chart that the IRS puts out that says if your income is this much and you live in this state, you get a deduction of X dollars, including any surtaxes you may pay as a result of the county that you're in, if the county adds a % or two to that sales tax. So that's a really nice one here for the state of Florida and any other state that does not have a state income tax. The third one that we see a lot of people using, and it's kind of specific, is the increased contribution limits and carry forward period of contributions of appreciated real property for conservation purposes. This was also made permanent. So what this means is typically when you donate an appreciated piece of property, you are limited to how much of that deduction you can take in any one given year to 30% generally on your tax return. If you give something away for conservation purposes, that limit is increased, either up to 50 or 100% depending on what you're doing. And what a conservation purpose means is you have a piece of property, you're going to donate part of it to the city, to the state, and basically it says that that property can never be developed upon. So it's kind of a nice thing if you have some property and you're looking to make that contribution. Again, that's made permanent, so that's a planning tip you can use. Another one we see a lot of our clients using is the above-the-line deduction for qualified tuition and related expenses, and that has been extended through the end of 2016. Again, this is just another way that you can deduct any education, college expenses that you may have. There are some credits still available. There's actually three different types of credits you can take. This just gives you another option as to how you want to deduct college expenses on your tax return. Basically, you could just run your college expenses 4 different ways and see which one gives you the greater benefit, and that becomes the way you should take it on your tax return. The good thing specifically about this qualified tuition and related expenses, this is an expense that comes off of your adjusted gross income. So this may have some benefits in other ways in your tax return. Also, the limit to take this expense is a little bit higher than it is for taking credits, meaning you can make a little bit more money before this phases out and you no longer get this deduction. The last one I want to briefly mention is the provision that was put back in place that you can make tax-free distributions to charity from your IRA of up to $100,000 in any one given year. This is a really nice planning tool for those individuals that need to make required distributions out of their IRAs and want to give money to charity. So what happens is the money goes directly out of your IRA, directly to the charity, and for those individuals, they're not going to be picking up that income in the year. So this is a great tool for anybody in that situation that wants to take money out of an IRA and wants to donate to charity.
Excellent. Thank you so much for that valuable information. Both you and Paul, Paul talking about the business extenders, and Jay, he's speaking about the individual extenders. So to close it out, we'll just briefly mention some of the other items associated with this PATH Act. And it's really the extended business credits portion of it, which we're very excited about here at PDR, as the research and development tax credit is part of our service offerings and has worked out really well for our clients. The research credit was made permanent. Additionally, beginning in 2016, eligible small businesses may claim the credit against AMT liability, and that is extremely important. The credit can be used by certain, even smaller businesses against the employer's portion of the Social Security portion of the payroll tax liability. So please be aware of that. It's out there. If you need additional information, please be sure to reach out to your professional tax advisor, as it's been very meaningful. Jay, anything you want to talk about that extension on the R&D tax credit?
Right. As we talk about this whole bill that was passed in December, this is actually the thing we're most excited about. The increase in the research and development tax credit, the ability to use it against the AMT, and the ability to use it against payroll taxes is perhaps the nicest thing put in this bill. If you are eligible to take the R&D credit in any one year, this will greatly use your utilization rate on this. Again, this is a whole topic in of itself, but this is actually a really great thing. If you're able to take the R&D credit, please look at these provisions.
And from time to time, PDR, we conduct webinars and post information related specifically to some of our service offers, including the R&D tax credit, cost segregation studies, which can really help improve cash flow for a lot of businesses. Paul, anything you want to add on that?
I do have one thing I want to add. There's a lot of misunderstanding in terms of what companies actually qualify for the research and development tax credits. A lot of people think of just life sciences and technology companies qualifying. However, manufacturers qualify, electrical contractors can qualify. I know of fabrication companies, companies that fabricate steel or other products can actually qualify. Anything that is a design build, anything that is a process of enhancing your process within your organization now qualifies. Years ago, it used to have to be new and innovative to the world. Today, it only has to be new and innovative to your company to qualify as research and development.
Excellent. So again, knowledge is power. Isn't that what they used to say? Or I don't know. They used to have a public service announcement about that stuff. So it's always valuable to be able to get as much information as you can and make a proactive approach to tax planning. One last thing that two things actually. There's also the work opportunity tax credit that's been extended through 2019. And it's also, this is one of those credits that you need to be, this is one of the credits that you really need to be proactive in filling out the paperwork and applications, as signatures need to be made within first, well, I'll clean that up. I'll clean that up afterwards. All right. Hey.
We have 5 minutes. Do you want me to who qualifies for the work opportunity?
Yes, we can talk over this.
We heard late. Yeah,
all right. One thing. When I asked you about that, I think the insolvency. What does the insolvency come? That comes in.
That comes in, but I was thinking that's kind of beyond the topic because those rules didn't change.
Okay.
And
all right.
That's the same.
And that's that Form 982, and that applies for Schedule E.
It is, but those are completely the same. Nothing there has changed from what it's been.
Okay. All right.
So it's a whole other topic in of itself.
Okay. All right. So let's take this over again.
Just pause for a second.
Yeah. Two other items to end with. The work opportunity tax credit and some of the new legislation around the Affordable Care Act. So first off, The Work Opportunity Tax Credit was extended through 2019. The law also modifies the credit beginning in 2016 to apply to employers who hire qualified long-term unemployed individuals. And those are defined as individuals who have been unemployed for 27 weeks or more, and increases the credit with respect to such long-term unemployed individuals to 50% of the first $6,000 of wages. Paul, I know you have some additional information as to the individuals that qualify.
Yes, as employers, keep an eye out for individuals that you hire that may qualify. First of all, people that are recipients for what's called the Temporary Assistance for Needy Families, TANF, if they receive that type of assistance within 18 months before the date of hire, they would qualify. Qualified veterans would end up qualifying for the credit. A qualified veteran is one that typically has some sort of financial, they have to be below a certain income threshold in order to qualify. And also ex-felons, qualified ex-felons, again, below certain income thresholds. And designated community residents, residents within what are called empowerment zones. And in addition to that, summer youth employees, qualified food stamp recipients, people that are on SSI, and long-term family assistance recipients. So there are a lot of different individuals that you hire that may qualify. You should, upon hiring those individuals, make sure they look at the list and see if any of these apply, because it could be up to a $3,000 savings to the company per employee.
Thank you. And lastly, I know we've all heard quite a bit about the Affordable Care Act, and the legislation suspends for 2 years 2 new taxes that were installed as part of that health care reform law. First, the excise tax on medical devices is suspended and will not apply to sales between January 1st, 2016 and December 31st, 2017. And secondly, the 40% excise tax on high-end health insurance plans, also known as the Cadillac tax, which would have applied beginning in 2018, will instead apply for tax years beginning after 2019. Gentlemen, thank you so much for your information. Any closing remarks? Excellent. All right, close it up. We'll close it up.
Yeah, anyway, sorry, I was right there.